Most Americans are watching the wrong trade war. We follow the headlines about tariffs and trade negotiations, about diplomatic summits and military posturing. We track stock tickers and quarterly earnings reports. We debate which central bank will cut rates first or which tech company will dominate next quarter. But none of that is the real story. The real story is happening in commodity warehouses across 3 continents. It's happening in mining contracts signed in languages we don't speak. It's happening in shipping manifests and strategic reserve facilities that never make the evening news. And by the time most of us understand what's occurred, it will already be over. There's a pattern unfolding right now in global markets that represents something far more significant than ordinary economic competition. It's not about one country gaining temporary advantage over another. It's about the fundamental restructuring of where economic power resides and what that means for America's position in the world. China is systematically acquiring physical control over the materials that make modern civilization function. Not financial derivatives, not paper contracts, not promises. Actual physical resources, metals, minerals, rare earth elements that you cannot manufacture a smartphone without, that you cannot build an electric vehicle without, that you cannot produce a solar panel or a missile guidance system or an MRI machine without. This isn't speculation or conspiracy. This is documented strategy backed by hundreds of billions of dollars in actual transactions across global commodity markets. It's happening through state-owned enterprises with functionally unlimited funding and a planning horizon measured in decades rather than the quarterly cycles that drive American corporate thinking. And it represents what may be the largest and most consequential wealth transfer in modern history, one that directly threatens American economic dominance. To understand why this matters to every American with a savings account, a 401k, or a dollar in their wallet, you need to understand something about how economic power actually works. Control over money is one form of leverage, but control over physical resources is something more fundamental. If you control the raw materials, you determine who can manufacture. If you control manufacturing, you influence prices. If you influence prices, you shape economic outcomes for entire nations. This is not complicated. It's actually elegantly simple once you see it clearly. And Beijing has been executing this strategy with remarkable patience and discipline, while American attention has been focused elsewhere. The scale of what's happening becomes clearer when you examine specific materials. Consider rare earth elements. These metals with names like neodymium, dysprosium, and terbium sound obscure, but they're absolutely essential for technologies Americans depend on daily. They're in the magnets that power electric vehicle motors. They're in wind turbine generators. They're in smartphone screens, in computer hard drives, in the military targeting systems that protect our troops, in the medical imaging equipment in our hospitals. China currently controls between 70 and 90% of global rare earth processing capacity. That's not mining, that's processing. Even when rare earths are extracted from the ground in Australia or right here in the United States, they often get shipped to China for refinement because that's where the specialized infrastructure and expertise exist. This represents a strategic bottleneck that didn't happen by accident. It was built methodically over decades while American policymakers were asleep at the wheel. Now that same strategic approach is being applied across the entire spectrum of industrial metals. Copper, which forms the backbone of electrical infrastructure in every American city. Lithium, which powers every battery technology from the phone in your pocket to grid-scale storage facilities. Cobalt, essential for battery stability and the aerospace systems our military depends on. Nickel, critical for both metallurgy and battery cathodes. Platinum group metals for catalytic converters, fuel cells, and chemical processing. The list extends across dozens of materials that most Americans have never thought about, but that our entire way of life cannot function without. What distinguishes this from normal market activity is the nature of the buying. This isn't opportunistic purchasing when prices dip. This is systematic, strategic stockpiling by state-backed entities operating with patient capital and coordinated purpose. Month after month, year after year, Chinese companies are outbidding American and European firms for mining rights across Africa and South America. Metal imports continue rising even when Chinese manufacturing output is flat. Strategic reserves are being built that dwarf anything the United States maintains. The evidence shows up in unusual price movements across commodity markets. It shows up in shipping data and trade flows. It shows up in the growing gap between what China consumes domestically and what it continues to import. And here's where the financial implications for every American become particularly concerning. Every dollar that China spends acquiring physical resources is a dollar being converted out of US currency and into tangible assets with intrinsic industrial value. This represents a deliberate transformation of paper reserves, our paper, American dollars, into the building blocks of future technology and manufacturing. Think about the position Beijing found itself in after decades of running trade surpluses with the United States. They accumulated enormous quantities of dollar-denominated assets, primarily U.S. Treasury bonds and dollar reserves. For years, we viewed this accumulation as a form of mutual dependency. They held our debt, we bought their goods. But this was always a peculiar arrangement, because those reserves only maintained value if the dollar itself maintained value. The strategic vulnerability became increasingly apparent to Chinese planners. If you're holding trillions of dollars in a currency being steadily debased through Federal Reserve monetary expansion, your real purchasing power erodes over time. You're essentially holding American paper while real assets appreciate. So China made a choice. Rather than continue accumulating paper promises from Washington, they would convert existing reserves into physical assets that maintain value regardless of what the Federal Reserve decides to do. Industrial metals don't care about Jerome Powell's interest rate policies. Copper has the same electrical conductivity whether American inflation is 2% or 12%. Lithium stores energy in a battery whether the Fed prints money or contracts the money supply. This conversion has been happening through thousands of individual transactions, each one representing a decision to hold less American paper and more physical material. The cumulative effect is a steady reduction in dollar demand from one of the world's largest reserve holders. The timing has accelerated recently. Tariff policies that dramatically reduced trade volumes between our two countries also reduced the normal flow of dollars into the Chinese economy. Beijing's response wasn't panic or desperate negotiation, it was adaptation. Trade with partner nations increasingly happens in renminbi rather than dollars. Existing dollar reserves are being deployed more aggressively to acquire resources before those American dollars lose additional purchasing power. Alternative trade and financial systems are being constructed that don't depend on American infrastructure or American rules, and we're watching it happen in real time. The silver market offers a particularly vivid illustration of these dynamics playing out right now. Silver has evolved from a primarily monetary metal, used historically for coins and as a store of value, into something governments now classify as strategically critical. It's essential for advanced semiconductor manufacturing. Solar panel production requires substantial quantities. Military defense systems that protect American interests worldwide depend on it. Aerospace, medicine, electrical infrastructure all require reliable silver supply. The challenge is that mining production isn't keeping pace with exploding demand from these competing sectors. Too many buyers are chasing insufficient physical metal. Basic economics predicts rising prices, and that's exactly what has occurred. Silver has appreciated approximately 150% since the beginning of 2025, trading above $76 per ounce at current levels. But the price movement alone doesn't capture what's actually happening beneath the surface. In Chinese markets, both institutional and retail investors have recognized something that Wall Street prefers not to discuss openly. The paper silver markets, futures contracts, exchange-traded funds, synthetic instruments, may represent claims on far more silver than physically exists in vaults available for delivery. Estimates suggest there could be more than 100 contracts claiming ownership for every actual ounce of deliverable metal. Once investors understand this reality, the rational response becomes obvious. If you want actual exposure to silver, you need physical metal in hand. Paper promises become increasingly suspect when the ratio between claims and deliverable supply reaches extreme levels. This realization has driven remarkable behavior. Silver investment funds operating in China have become massively oversubscribed. The UBS Silver Fund has seen investors pay premiums of 60% above the net asset value of the underlying metal. They're paying $160 to access $100 worth of silver, simply to secure exposure through a vehicle with credible metal backing. From a pure investment standpoint, paying 60% premiums is extraordinarily risky. If those premiums compress toward normal levels, investors face substantial losses even if underlying silver prices remain stable. This is speculative behavior by any reasonable measure. But the psychology revealed by this behavior is more important than the behavior itself. It tells us that physical silver supply in China has become so constrained that normal acquisition channels have broken down. It tells us that investors genuinely fear future unavailability, that they won't be able to acquire any silver at all regardless of price, so they're willing to pay whatever it takes today. The premium gap between Chinese domestic silver prices and international prices has reached approximately 10%. In efficient markets, this arbitrage would be instantly exploited. Traders would move metal from lower-priced regions to higher-priced regions until prices equalized. The persistence and widening of this gap indicates that physical supply constraints have become severe enough to break normal market mechanisms. This pattern in silver reflects dynamics playing out simultaneously across multiple industrial metals. The same psychology, preference for physical over paper, fear of future scarcity, aggressive conversion of financial assets into tangible materials, is driving behavior across copper, lithium, cobalt, and dozens of other critical inputs. Meanwhile, American investors remain largely focused on stock prices and interest rate predictions. There's another major factor accelerating these trends that receives insufficient attention from American financial media. Japan. The Bank of Japan has begun raising interest rates after decades of near zero or negative rate policy, and they've signaled that additional increases are coming throughout 2026. This matters enormously to American investors because of Japan's position in our financial architecture. Japan faces a collapsing yen currency that hasn't recovered despite rate increases. A weakening yen makes all imports more expensive, feeding directly into Japanese domestic inflation. Their central bank has made clear that defending the yen has become their absolute priority. But Japan also carries gross government debt approaching 250% of GDP, among the highest debt burdens in the developed world. To continue raising rates without causing debt service costs to explode, they need to generate cash from somewhere. The most realistic source is selling foreign assets, particularly U.S. Treasury bonds. Japan currently holds more than $1 trillion in U.S. Treasury securities, making them one of the largest foreign holders of American government debt. If they begin unwinding even a portion of that position to fund monetary policy and currency defense, it creates significant pressure on our bond markets and, by extension, the dollar. This matters directly to Americans because Treasury yields affect everything from mortgage rates to corporate borrowing costs to the federal government's ability to finance its operations. But there's a second mechanism that's equally important, the unwinding of the yen carry trade. For more than a decade, the yen carry trade has been one of the largest and most profitable strategies in global finance, and it has funneled enormous amounts of foreign capital into American markets. The mechanics are straightforward. Borrow yen at extremely low Japanese interest rates. Convert those yen into dollars. Use those dollars to purchase higher-yielding U.S. assets, Treasury bonds, corporate debt, American equities. Pocket the interest rate differential as profit. When executed with leverage, returns can be substantial. This trade has channeled enormous capital flows into American markets for years, supporting our asset prices and helping keep our yields lower than they would otherwise be. The trade only works, however, under specific conditions. Japanese rates must remain very low, and the yen must stay weak or stable relative to the dollar. As Japanese rates rise, the fundamentals deteriorate rapidly. The interest rate gap narrows, reducing profit potential. More critically, the risk profile transforms entirely. If the yen appreciates significantly, borrowers must repay their yen-denominated loans using a suddenly stronger currency. The amount owed in dollar terms increases substantially. Meanwhile, the U.S. assets purchased with that borrowed money may be declining as American markets correct. Losses compound on both sides of the trade simultaneously. Every sophisticated fund manager involved in this trade understands that risk has become extreme. The mathematics no longer work. The prudent response is to exit, and exits are happening. Money flowing out of U.S. assets, selling pressure on American bonds, reduced demand for dollars. This is occurring at precisely the same time as all the other dollar-negative factors we've examined. Step back now and connect these threads together. This is what American investors need to understand. China is systematically converting massive dollar reserves into industrial metals, rare earths, and critical materials, while simultaneously building alternative trade systems that bypass American financial infrastructure. The dollar is already in a structural down cycle, declining more than 8% against major currencies this year alone, on pace for its worst annual performance since 2017. Options traders on Wall Street, professionals who make their living betting on currency movements, are extremely bearish on the dollar. And they're bearish for a specific reason that every American should understand. Dollar down cycles driven by structural factors, rather than temporary sentiment, typically last 5 years or more once they begin. This pattern has played out multiple times historically. We're only in year one of what could be an extended journey. Japan is preparing to potentially sell hundreds of billions in Treasury holdings, while the carry trade that has supported American asset prices for over a decade continues unwinding. Global trade patterns are shifting away from dollar-denominated transactions. Strategic resources are appreciating relative to fiat currencies across the board. These are not isolated events that can be analyzed separately. They're interconnected parts of a fundamental shift in how the global financial system operates and where economic power resides. The effects don't add together linearly. They multiply, they create feedback loops. Each factor amplifies the significance of the others. Here's what most mainstream American analysis misses. Wall Street tends to compartmentalize these issues. Trade policy in one box, monetary policy in another, geopolitical competition in a third. But complex systems don't respect those boundaries. Everything affects everything else. The interactions and feedback loops are where consequential changes actually occur. The United States will very likely need to create additional money to fund our own belated strategic stockpiling of critical materials. That means more dollar supply entering the system. Both superpowers are now competing for the same finite physical resources, and both strategies put sustained downward pressure on dollar value. There's a deeper dynamic at work here that every American with savings or investments needs to understand. For most of the past 50 years, our financial system operated under a particular set of assumptions. The dollar would remain the unquestioned global reserve currency. Treasury bonds would serve as the ultimate safe haven. Financial engineering could substitute for physical industrial capacity. Asset price appreciation would continue indefinitely through Federal Reserve management. These assumptions shaped how we invest, how we plan for retirement, how our corporations make decisions, and how our government sets policy. They became so embedded in American thinking that questioning them seemed almost absurd. But assumptions are not laws of nature. They're contingent on underlying conditions that can change. What's happening now is not a normal market cycle that will reverse when the Federal Reserve adjusts interest rates or when some trade agreement gets signed. This is a generational shift in the structure of the global financial system. The framework that has benefited America since the end of World War II is being challenged, not through military invasion or dramatic confrontation, but through patient strategic economic positioning. China has been playing a long game for decades, systematically accumulating the physical foundations of industrial power, while we focused on financial engineering and asset price appreciation. Their strategy involved accepting short-term costs in exchange for long-term structural advantage. It required coordinated action across government, state enterprises, and private sector actors operating toward common objectives. Meanwhile, our political system lurches from one election cycle to the next. Our corporations optimize for quarterly earnings, and our policymakers form committees to study problems that our competitors solved years ago. Japan, our close ally, is being forced by circumstances beyond their control to prioritize yen stability over continuing to support American markets with their capital. This isn't a choice they're making to hurt us. It's a response to economic pressures that leave them with limited alternatives. The dollar is caught in the middle of forces that cannot be easily controlled through traditional Federal Reserve tools. You cannot simply raise interest rates and make these structural problems disappear. The challenges are more fundamental than anything adjustable through monetary policy decisions. Consider what this means for the architecture that has served American interests for generations. Reserve currency status has historically conferred enormous advantages to our country: lower borrowing costs, the ability to run sustained deficits, the capacity to project economic influence globally through our financial system. But reserve currency status is not permanent. It has shifted before in history, and the factors that supported dollar dominance are weakening simultaneously rather than sequentially. We're not necessarily witnessing the immediate end of dollar primacy. Transitions of this magnitude take years or decades to fully manifest, but we may be witnessing the beginning of a shift toward a multipolar currency system, one where the dollar remains important but no longer enjoys the overwhelming dominance it has exercised since Bretton Woods. This has implications that extend far beyond currency markets into the daily financial lives of ordinary Americans. If real physical assets become more valuable relative to paper currencies, it changes how American families should think about preserving wealth across generations. If control over strategic materials becomes the primary determinant of industrial capacity, it changes how American economic power can be exercised. If traditional safe havens no longer perform as historically expected, it changes how American investors should allocate capital during periods of uncertainty. The rules that governed American financial decision-making for the past half-century may not apply to the next half-century. This doesn't mean abandoning everything that worked before. It means recognizing that context has changed and strategies must adapt accordingly. The year ahead is setting up to be extraordinarily volatile for Americans holding dollars and dollar-denominated assets. Multiple severe structural headwinds are converging simultaneously, rather than appearing in sequence where each could be addressed individually. This is not like previous dollar down cycles where a single primary cause could be identified and eventually addressed. Trade policy, monetary dynamics, geopolitical competition, and structural changes in how global commerce operates are all moving in the same direction at once. Most American financial analysts are underestimating how these factors multiply when they converge, rather than simply adding together. The models used to predict currency movements weren't built for conditions where 4 or 5 major forces all point the same way simultaneously. But in the end, this isn't really about currency movements or market volatility. Those are symptoms of something more fundamental. This is about who understands how the system actually works, and who is still operating under assumptions that no longer apply. The decisions being made right now by governments, central banks, and individual Americans will echo for decades. Positions being established today in physical commodities, in strategic materials, in control over supply chains, will determine which nations can build advanced industries in 2040, and which ones will be dependent on others for permission. Most Americans won't recognize what's happened until the transfer is complete. That's the nature of shifts this consequential. They occur gradually enough that each individual transaction seems unremarkable. Each policy decision appears incremental. Each market movement looks like normal fluctuation. Only in retrospect does the pattern become clear. By then, the resources will already have changed hands. The strategic positions will already be occupied. The architecture of the new system will already be under construction. And those who are watching the wrong headlines will wonder how they missed it.